So thanks everyone so much for joining us on today's webinar, Redefining E-commerce Success, the Journey to Investor-Ready Financials. My name is Jeff, and I'm the head of marketing here at A2X, and I'm joined by two subject matter experts, Anna Briggs, head of partnerships at Settle, and Sam Hill, founder of Ecom CFO. Sam, I'm going to say this, you might laugh, is kind of the godfather of the term investor-ready financials for e-commerce businesses. So I thought it would be really great for him to introduce Ecom CFO and why they're so well suited to talk to this topic.
Yeah, thanks so much, Jeff. My name is Sam Hill. I am the founder of Ecom CFO. We provide outsourced CFO, accounting, and financial operations to 10 million plus e-commerce brands and online retailers. And we really exist to provide the best-in-class products and services to our e-commerce market in general. And what does that really mean, and what is our vision for the future? It's not just about the accounting and the financial statements and the CFO services, but our vision is really to offer a full suite of products and services, not just to the owners of brands, but also to their C-suite executive team, their existing accountants, bookkeepers, or accounting firm, and really to cover all of the stakeholders in our ecosystem. So thanks so much for having me and Anna, Jeff, and I'm really looking forward to diving in.
Awesome. And then speaking of diving in, we'll talk a little bit about today's agenda. So first and foremost, we're going to talk about the stages of investor-ready financials so that we can kind of create a map and allow people to see where they are on their journey to this holy grail. And then we're going to talk about the roadmap tips and tricks to investor-ready financials, as well as the obstacles and mistakes to avoid. And at the end, we're going to jump into a Q&A. So stages of investor-ready financials. The way that we've broken this down is into 4 key stages. 1 is no accounting, 2, cash accounting, 3, accrual accounting, and then lastly, investor-ready financials. Most of you are likely going to find yourself at the cash accounting or accrual accounting stage. Although, and you might be surprised, we have seen 6-figure sellers plus in the no accounting stage before here at A2X. But I'll say for the most part, if you're joining this investor-ready financials webinar, you're likely a growing or scaling business trying to set yourself up for potential lending, investors, M&A, so on and so forth. So very likely in the cash or the accrual accounting stages of your journey. The differences between cash and accrual, quite simple. Cash, transaction recorded at the time money changes hands, and accrual, transactions recorded at the time it takes place. So when there is an exchange of value. So we'll dive into these 2 concepts really quick and talk to you a little bit about why they are not investor ready. And then Sam will transition into talking about what investor-ready financials really is and how you can set up your business to get there. So first and foremost, cash accounting is not investor-ready because cash accounting is transactions recorded at the time in which they occur. It lacks a tremendous amount of financial detail as it doesn't account for money that is owed but not yet received or expenses that have been incurred but not yet paid. This, as you can imagine, creates this environment where you lack visibility into your profitability. If you're tracking your revenue when it occurs, but you're not tracking the associated expenses that are required to get that revenue, you don't have a great understanding of what your margins are and how your business is actually performing over the long term. In addition to that, revenue and COGS do not match in the period they occurred. This kind of speaks to the first bullet. Sam, before we jump into accrual, anything that I might be missing on cash accounting for those in our audience that are currently on this accounting method?
Yeah, I just want to say one thing too, that cash accounting is not inherently wrong, and it should align with the complexity of the business. So if you're just starting out, there's no reason for you to jump to investor-ready financials. You could still be maintaining cash accounting, and maybe you're managing the business or margins or other reporting on some other software or tool or spreadsheet. So it's not until the business starts to get more complex, more revenue, more payroll, where you want to start migrating to accrual and then eventually investor ready. And just one more point on the frowned upon by potential lenders, investors, and acquirers. The reason is because they can't make an honest assessment of the business and understand profitability and important KPIs that they're trying to use to make a good investment decision. I just want to call out those couple things.
100%. So definitely agree with you. Not frowned upon. It's appropriate given the stage of growth in your business. And kind of the same can be true for accrual, which we're going to jump into just a little bit. Accrual being recording transactions when there's a value exchange. So Sam, I'm going to let you jump in and talk a little bit about why accrual as your business is scaling.
Yeah, we tried to put together a really simple example of what a business would look like over, let's call it 8 months, and some just very basic assumptions to illustrate the difference between accrual and cash and why you would ultimately choose accrual. So I'm going to try and get fancy and annotate here. But all this is saying is, hey, I'm selling something for $250. It costs me $100, and I'm going to put in orders throughout the year. And I'm going to write checks for that order when the inventory is delivered. So these are the actual check dates. Then let's just assume, and we've just made these up for example purposes, but we sell 1,000 units in month 1, 500 units in month 2, 2,000 in month 3, etc. So here are my sales for the period. But my cost of goods sold, because I didn't write an actual check in month 1, I have no cost of goods sold under the cash method. So my gross profit is my total $250,000 in this example. So my gross profit margin is 100%. And you'll see in future months how that gross profit margin continues to bounce around. So I'm 20% here, I'm 100% here, I'm negative gross profit here, and so on. And my final total here is 45%. And so that's a very different view than the next slide under accrual method. So exact same assumptions from the top, exact same payment schedule for the inventory. These have not changed, but you'll notice that I'm multiplying the units sold times the unit cost in the period those units are sold. So my gross profit margin ends up being a consistent 60% across all the months. Now, obviously, in a more complex business, this gross margin starts to shift because of discounts, returns, freight, and inventory variances, a whole number of things. And so obviously this gross profit margin would change, but to illustrate the point, we want to demonstrate why the accrual method is so important, and specifically on the cost of goods sold and booking it in the period that the sale is made. So it's a more complicated way of saying you should choose accrual and why there's really a difference.
And I would imagine that from an investor or a lender or a potential acquirer's perspective, the lack of variability around your profit margins and just kind of having clear visibility into what the business is worth at any given point in time is significantly easier to make a strategic decision than cash on the previous slide, where there was just a tremendous amount of variability.
Yeah, no question. And we'll kind of see some of those lessons on the next slide as well. And, we get this question a lot as a firm saying that, isn't cash more conservative? Aren't I being more conservative by booking those expenses in the month occurred? And you may think that the cash method is quote unquote more conservative, but this is just plain wrong. Because for the financial statements, we're striving for accuracy. And if your financial statements are telling you that you have a 60% gross margin versus a 45% gross margin, that would lead to drastically different decision making. I may think that I need to go renegotiate with my supplier or increase prices or fix my discounts and returns at 45%, but I may make a different decision at 60. And the other call out here, and this kind of speaks to my earlier point about just aligning the accounting to the business complexity is with a small number of SKUs and stable prices, the math is pretty easy, and you can easily manage this, on a spreadsheet. But as prices change month to month with the suppliers, and I add SKUs, I go from 10 to 100 to 1,000, it gets a lot more complicated. And so that's why you need a system like A2X or something else to make sure that you're accounting for all these properly. And then the last thing I want to mention is from the accrual side, from cash, the easiest example is cost of goods sold because it's so clear. But accruals don't just relate to inventory. They can relate to ad spend. They can relate to payroll. They can relate to insurance that you're paying on you're paying a yearly premium for insurance, but you need to make an accrual for every single month. So just keep in mind that accrual doesn't just equal cost of goods sold and inventory. Awesome. Okay, so this is what gets me fired up. So we came up really with our own definition of investor-ready financials, and we've crafted this definition over the last few years to make it as simple as possible and to give a more technical accounting definition. So the way we define investor-ready financials is your financial statements are ready to be given to an investor, and that investor also includes you. You are generally the largest investor into the business. And those should be able to give to you with no additional work. And they're prepared on an accrual basis in accordance with GAAP. GAAP just stands for Generally Accepted Accounting Principles, and free from material misstatement that would impact an investor or a key stakeholder's decision. And we'll get into the technical aspects of that in a second. But the second sentence is really important too, that not only are they on an accrual basis in accordance with GAAP, no material misstatements, but all of the accounts are properly categorized and grouped together in a manner appropriate to an e-commerce business, because e-commerce is very different than a lot of other business types. And we want to maximize the clarity for all the relevant stakeholders, not just management, but also for banks, auditors, investors, board members, etc. So that is the long-winded technical definition of investor-ready financials. This is my absolute favorite slide in the presentation. And what this slide says is the difference between what investor-ready financials are conceptually and what they are tactically. So conceptually, if we're speaking to a potential client, business owner, conceptually, it means that you, as the owner, understand the financials and you're taking ultimate responsibility to speak to them. So it's not just this is what my accounting firm said, this is what my bookkeeper said. It's really, you have to be investor ready and be prepared to speak and take responsibility for what the numbers are saying. The second point is the investor, again, including yourself, should be asking fewer and fewer questions of the financials, like, hey, what does this mean? Or what's in this bucket? Or why is there a balance in this account on the balance sheet? So those investors, including yourself, again, should be asking fewer and fewer questions. And then the last part is that you should have robust processes to support the investor-ready financials. So it's easier to do a one-time cleanup and everything's clean for 1 month, but then what happens the next month and then the next month? Because your investors, again, including yourself, are going to continue to ask for this. And if you don't have the robust processes to support it, then you're not going to continue to be investor-ready. So that's conceptually. Tactically, there's really 3 key areas. The financials need to be complete, categorized, and have the correct level of detail. So what do we mean by this? Complete means the financials represent the entire business. We see a lot of clients that, hey, we're making good accruals, everything's lined up properly, but we don't have purchase orders in the system, oh, we're missing a lot of invoices that are in an email inbox or some other system somewhere that are not entered into the accounting system. So the whole business needs to be included in the financials. Number two, categorize. We talked about this a little bit in the definition, but the financials should follow a logical and intentional account structure that aligns with GAAP. What does this mean? Well, sometimes we see merchant fees, credit card fees, fulfillment expenses in cost of goods sold, and those need to be put in a different section because they're not COGS. That's just one example, but that should cover categorized. And the last thing is the correct level of detail. So material parts of the business aren't lumped all together. And the best example of this is usually in revenue. So sometimes we'll see just one line for revenue, but that doesn't include what are my discounts for the period? What are my returns? Is all my ad spend lumped together, or have I broken it out by Facebook, Google, direct mail, SMS, all these different key areas of the business where that investor, again, including yourself, can see that level of detail and ask fewer questions and understand your business very quickly.
Awesome. That's amazing. So thank you so much for giving us the definition and then the conceptual and tactical execution of investor-ready financials. I think this is a good segue to Anna, who's going to talk about investor-ready financials from the perspective of the potential lender or investor. Before we get to that, though, we do have the benefits of investor-ready financials. Sam did a really incredible job of capturing those as he was going through the definition. But effectively at a high level, and this is like totally not inclusive of all the benefits, but investor-ready financials gives you confidence and compliance. Because you're not asking questions of your number, it puts you in a position to make better decisions about your business because you have really great visibility into what's actually happening. Talked about this quite a bit, but it's more attractive to investors, lenders, and acquirers, less risky to lenders, and then required by board of directors. Before we pass the mic over to Anna, Sam, anything that I might be missing?
No, I think that's an excellent summary. And I think one of the benefits that may be missing here is just peace of mind, knowing that the financials that you have that you're presenting to yourself or these external people are correct. We have a lot of times with clients that haven't worked with any sort of accounting firm, let alone us before. Just keep asking the question. I don't know if my financials are correct. I don't know if they're accurate. I think we're missing something. And to have that peace of mind, knowing that the financials are good to go and you can focus on other strategic priorities, I think has been a gigantic win for our clients in particular.
100%. Cool. And then who should strive for investor-ready financials? So you talked about there being a time and place for cash, a time and place for accrual. Investor-ready financials is kind of the next evolution of accrual. I asked you this question and you gave me a really great definition. You said, any growing e-commerce business with a run rate of 10 million that wants to set themselves up for a positive outcome. Positive outcomes could be M&A, could be investors, could even be lending to help kind of continue to fund the growth of the business. You did say, though, that there were a few exceptions below the $10 million mark. Do you mind providing those exceptions here?
Yeah, absolutely. So yeah, we use the general rule of thumb for 10 million plus, but there's certainly arguments to be made for less than 10 million. And number one, just for peace of mind, if you could still strive for investor-ready financials being less than 10 million, but the common exceptions we see to this is manufacturers. So if you're manufacturing the product, if you own the equipment, if you have manufacturing labor and you're less than 10 million, you're in that like 5 million range, you should absolutely be striving for investor-ready financials because there's so much more business complexity. And the other exception I would make is if you have a lot of SKUs and you're omni-channel and you have 10 different merchant accounts, if you're selling on Affirm, QuadPay, PayPal, Stripe, and there's so many accounts to reconcile and you're selling in multiple countries, you should absolutely be striving for investor ready financials, even if you don't meet the 10 million threshold here.
Awesome. And then from the perspective of the lender or investor, Anna is coming to us from Settle, who have a flexible working capital product and help support e-commerce businesses and know exactly what to look for when providing a lot of these services. Anna, do you mind providing a high-level overview of Settle and then jumping into what you look for when working with e-commerce businesses, specifically as it relates to their investor readiness?
Yeah, absolutely. And thanks very much, guys. So at Settle, we work with hundreds of e-commerce merchants to help them optimize their cash flow through a couple of different things. We have an all-in-one software platform to help brands with their accounts payable and purchasing workflows. And then we layer on top this flexible working capital. So we look at like thousands of companies' financials every year. And really just want to highlight, like, once you have your investor ready financials, what are the key things that any partner who you bring on is really going to focus on, so that, like, kind of to Sam's peace of mind point earlier, like, you can give yourself a little peace of mind, like knowing exactly what to focus on. So the first is revenue growth. I think that's generally pretty straightforward for most folks, but basically any partner, whether that's a lender, an equity investor, a potential acquirer, they just want to see that the business is growing and there's going to be opportunities to expand the relationship in the future, and that is going to continue to be around. So one of the easiest ways to validate that is that the company is growing its revenue. So that one is relatively simple. Unit economics is really where we start to differentiate businesses who are playing in the same space. So thinking about gross margin, if, for example, you're selling kombucha and you're doing that at like a 60% margin, and you have a competitor who has a similar product at a 30% margin, you're going to be able to really weather any off-plan performance or market changes and just be a more like sustainable business. So that's going to be something that's really compelling and that you'll want to highlight. Another thing to kind of dial into is also your contribution margin, which takes into account how much you're spending to actually acquire your customers. So that's definitely going to be not only industry specific, but also channel specific. So that's where it gets really important to just understand your business model, work really closely with, any advisors who you have, your accounting team, your finance team, to really understand, okay, what is my performance for my business across different channels, and be able to speak to that. So liquidity, we're really just looking at cash runway, which again, I think is a pretty simple one. Basically, just what's your cash position relative to how much you're burning on a monthly basis. So this kind of gives a picture of how many more months of operating runway you have. And, for companies who are producing physical goods, a lot of that cash is going to be tied up in inventory. And so ultimately you're perpetually going to have a pretty tight runway. But one of the best times to actually go out to like a lender, for example, or an acquirer, or potentially like another investor, is when your cash runway is the longest, which is typically right after an equity fundraise. That's really when there's sort of like the strongest vote of confidence that your business is going to be around for the next year or two. And that's a great time to go out to look for other sources of capital at a low cost. For asset efficiencies, that's really where we try to help sellers at Settle. So we really look at the cash conversion cycle, which is a super critical metric. So that's measured really from the moment that you instruct your manufacturer to produce the goods to the moment that you're actually receiving cash from that sale. So that whole gap is your cash conversion cycle. And again, like, it's going to vary by business and by channel, but there's a couple of ways that you can make improvements there. And the biggest one that we recommend is work with your suppliers and your retail partners, if you have them, to get better terms. That's effectively free credit that you can get from your partners, and that's going to shorten your cash conversion cycle. But really, what we see for most scaling companies is they're going to need something to supplement it, whether that's credit cards to get started or bringing on a working capital provider like Settle. They need something to kind of bridge that gap, because it's going to just be kind of a constant in the business. A healthy cash conversion cycle is generally around like 120 days. It gets pretty elongated at like 180 to 210, and anything under 60 is really strong. And then the last one is leverage. So basically, the debt to equity ratio just gives us an understanding of, can your company service the debt that it's taken out? So in a situation where you have $1 million in assets, but you have $2 million in debt, your assets aren't going to cover all of your debt obligations in a situation where the company isn't around tomorrow. So that's something that any investor or lender is really going to take a lot of time to understand, is like, how are you going to grow your asset base to be able to cover all of your liabilities? So for that reason, it's not always the best idea to take the biggest chunk of debt capital that you can get from a lender, because if you don't really have the ability to pay that back, then it's going to hinder your ability to get equity, to potentially get like a lower cost debt provider in the future. So it's really important to just make sure that you're only taking on the debt that you can afford. You don't have debt sitting on your balance sheet that you're not using. And again, I think like that also just really highlights the importance of working with the right team around you and really making sure you're having a lot of conversations with any investor or lender who you're bringing on to understand what's exactly right for your business.
Awesome. Great. Thanks so much, Anna. Sam, anything you'd like to add on this slide?
I don't think so, other than, again, these are fantastic ratios that you as the owner should be paying attention to and have the financial reporting to support it. And it just goes back to having investor ready financials makes calculating all of these ratios for yourself and for Anna's company Settle so much easier. And if your financials are investor ready, you can calculate these in 2 minutes, versus if you're not, you're going to spend hours and hours or weeks and months of accountant time trying to get your financials to the point where you can calculate these ratios.
Yeah, proactive as opposed to reactive with your accounting. Awesome. Okay, so we've talked a little bit about the stages of investor ready financials, why it's so important for businesses, what partners, as in lenders or investors, look for in businesses from an investor readiness perspective. Now, how do you get to investor ready financials, which is the next point of the webinar? Sam has done a really great job, and the Ecom CFO team has done a great job in breaking this down into 3 key areas. 1 is obviously accounting, 2, systems, and 3, people. And Sam's going to jump into each of these sections and talk about the considerations for all 3 on your journey to investor ready financials.
Awesome. Yeah. So clearly, to get to this point to investor ready financials, you have to have the accounting system to support it. And not only, system selection, whatever accounting platform you're choosing, but almost more importantly is clearly articulated revenue recognition and expense policy. So what do I mean by that? When is revenue recognized? Is it the point at which the order is paid? Is it the point of which the order is fulfilled? Do you know? And can you communicate that to an external party asking about your financials? So similarly, you need to have a good inventory policy. So when does inventory hit the balance sheet? How often do you count it? Do you cycle count it? Do you do a physical count? Is it quarterly? Is it monthly? Is it annually? How many warehouses do I have? How do I treat inventory in transit? All these different things. A more sophisticated understanding of expense accruals, deferrals, and other timing adjustments. And again, the best example here is things like insurance. You may pay $20,000 in January for your policy, but are you accruing that across the entire year? And then one of the biggest items that we see as a miss is purchase order management. So purchase orders end up buried in WeChat or WhatsApp or email, and it's just a long email thread. But aggregating all those purchase orders with the relevant information and entering them into your accounting system is really critical for investor ready, because we need to know, and your investors need to know, okay, well, how much money have I committed to that I still haven't paid to my suppliers? And then on the balance sheet, there's a couple items there, but I don't think it's as relevant to go through. Cool. Okay. So you have to have the systems. If you have all the policies written down, that's great, but systems are your best friend here. So choosing the right accounting software, if that's QuickBooks, Xero, NetSuite, definitely three of the most popular. How to get to accrual accounting the easiest is, shameless plug, it's one of the reasons we're all here, is using A2X. And I will be the first to say that, we can choose any software that we want as a firm. We are not beholden to A2X or anyone else. And we have made the conscious decision over the last 4 years to choose A2X and implement it with every single one of our clients. And we do that for a reason, because it's awesome and it works. Having bill pay and purchase order management, again, like Settle, where you can have one source of truth for all of your accounts payable and accounts receivable. And then lastly, again, depending on the business complexity, you could choose to have all of these acronyms, and we'll walk through each one of them. IMS, WMS, or OMS just stands for Inventory Management System, Warehouse Management System, or Order Management System. If you're scouring the market for different systems, they all kind of call themselves different acronyms, but they all kind of mean the same thing. There's a little nuance between them, but having that system, if applicable, and then understanding the integration between those systems and your accounting platform is really, really important.
Awesome. And I think you had talked about A2X on the journey to accrual accounting. And thank you, by the way, for the comments. Very much appreciated. But we wanted to just take 2 seconds here for those of you that are unfamiliar with A2X and how it could help get you to accrual and investor-ready financials. It's a relatively simple concept, and I'll blow through it pretty quickly. But effectively, if you're selling on Amazon, Shopify, eBay, Etsy, Walmart, BigCommerce, or any of those other sales channels, and you're using QuickBooks, Xero, NetSuite, you're typically getting a payout as a deposit on your bank feed. Now, that payout usually encapsulates, and by usually, all the time, the collection of sales, fees, refunds, taxes, gift cards, and more associated with those sales channels. All A2X does is actually goes in and pulls the data from your sales channels and then automatically organizes each of the transactions into their appropriate categories over the time periods in which they occurred. And then from there, posts that summary to the accounting software, whether it's Xero, QuickBooks, or NetSuite, and matches it to the payout so that you have this neat summary with all of your transactions automatically categorized that matches to the payout so that you can reconcile the transaction and have a really clear picture of how the business is actually performing, so that when you're looking at your profit and loss statement, everything is broken down into its appropriate categories, into its appropriate time periods, allowing for proper accrual accounting. And then, as Sam had talked about, as a stepping point into investor-ready financials. So just wanted to take 2 seconds to talk about this for those of you that are unfamiliar with A2X. If you wanted to give it a try, please do so. You can go to a2xaccounting.com, and we offer free trials for pretty much any of the sales channels that you're selling on. Then the last step, Sam, sometimes gets discounted, but oftentimes is the most important one, which is the people. Do you mind jumping into this one?
Yeah, absolutely. And the first point here, this is where most people fail. And we've been doing this for a number of years, and I'm always surprised by the org charts of our clients, and because they're all very, very different. And you have to have the people to support the policies and the systems that we just talked about. And without this ability, it's just not possible. And the policies really don't matter if you don't have the people. So what do we see typically with our clients? Typically, it's someone on the operations side, and that depends on the operational maturity of the business and the complexity, how many SKUs, how many warehouses or 3PLs you're working with, how many countries you're selling on, of course. But we see this title called couple different things. So ops director, COO, ops coordinator, supply chain manager, warehouse manager, because there's so much work to do on the inventory and COGS and the operational components of your business, that you need that person that's capable of delivering that level of accountability and the detail for investor ready financials. Because you as the owner, you're working on marketing and you're working on product and you're working on launches or talking to partners or investors. And quite frankly, we just don't see most of the owners having the time to go to the level that's required to get to investor ready. So having those people in place is just absolutely critical. And the last thing here is this usually doesn't include the CMO or the marketing team. As an outsourced firm, if we're working on a higher level strategy or analysis or helping make decisions strategically, then of course we'll include the CMO or elements of the marketing team. But typically for the investor ready financials themselves and that preparation, we're usually not including the CMO or anyone from the marketing team. And I know that's counterintuitive because you spend the most time worrying about marketing, but actually to get to investor ready, it usually doesn't include a lot of the marketing team.
Helpful. So now that we talked about kind of the 3 steps in the journey, which is accounting, systems, and people, and you talked about kind of people being where folks often fail, it'd be great for you to dive into some of the other common obstacles and mistakes that you see on a business's journey to investor ready financials.
Yeah, of course. Some common obstacles. I mean, this is really just a summation of what we've already talked about, but it's really a lack of team and clear ownership. So who is responsible for creating those policies and executing them on a monthly, weekly, daily basis? Number 2 is a really important one, and that's expecting your accounting firm to serve as your operations team and solve operations issues. So, for example, Ecom CFO is not a Shopify development firm. So we may identify a breakdown in the process, and we may get to a point where we have agreed upon a change, but we're not going into Shopify and coding the shopping cart or the name of the SKUs or anything directly in Shopify. So again, you really need to have that experience and capability on your own team to fix those issues. And then also the outsourced accounting team is not your operations, warehouse, and logistics team. So we're not counting inventory. Some of the inventory variances that will inevitably happen, we can point you in the right direction of, we think it's this. We think that you're missing inventory in transit. We think that we're missing invoices or whatever the issue may be, but it's ultimately you and your team's responsibility to get to the very bottom of that issue. So those are probably the 3 most common mistakes that and obstacles that we see on our end.
Awesome. Now, we've gone through quite a bit of content today, and we talked about the stages of investor ready financials. If you're at the accrual stage and transitioning to investor readiness, or even at the cash stage and want to get to accrual or investor ready, this is not something you have to do alone. You could actually work with an expert e-commerce accountant. The A2X team works with the world's leading e-commerce accountants and bookkeepers. Ecom CFO at the top of that list is a gold partner with some of our other gold partners. So if you're interested in getting to what Sam has been talking about for the majority of this webinar, you're not alone. Feel free to reach out to Ecom CFO or any of the other accounting and bookkeeping practices in our directory. I will say, though, from an investor-ready financials perspective, I mentioned this earlier, Ecom CFO are definitely the godfathers of the term. We've actually been joking around on how they can trademark it. So they're going to go to their legal team and see what we can do about that.
Yeah, don't steal our trademark, please.
Cool. Okay, so we'll now take a second to jump into Q&A. I noticed that a few questions were actually answered in the chat. So I'll surface them, and then Sam or Anna, if there's anything else that you wanted to jump on or surface, let's do that at this stage. So the first question is, I understand on merchant fees, ad spend not being in COGS. How do you logistically use that information to figure out if a product is profitable? And then on the flip side, does A2X show profitability per SKU? Sam, are you cool to answer that question?
Yeah, absolutely. So this is a little outside the scope of our webinar today, but I want to make sure we address the question, because the overall concept here is use the right tool for the right job. And generally speaking, if you're using QuickBooks or Xero, the accounting system is not the best place to do that analysis by SKU. So we do not, under any circumstances, recommend you bringing individual orders into QuickBooks or Xero. We're a QuickBooks exclusive shop, so I'll just speak for QuickBooks. But we do not bring in the individual orders into the accounting system for a lot of reasons. And number one, you're gonna break it. Now, that's not to say that doing that analysis by SKU is not critically important. I'm just saying that you shouldn't use QuickBooks for that. You should use another software or a Shopify app or just Google Sheets if you want. And the merchant fees, ad spend, other variable costs that are attributed to an individual order, an individual customer type, an individual product, you should absolutely have an intelligent methodology to apply each of those costs to the appropriate level, if that's customer type, item, country, whatever it is, and determine if that's a profitable order, customer type. And I'll answer Jeff for you for the A2X part, but A2X does not show profitability by SKU. Again, it's trying to solve the investor-ready financial problem, not the individual SKU or profit per SKU reporting.
Cool. Thanks, Sam.
Anna already answered this question in the Q&A, but I want to address it directly.
Definitely. I can read it out for you.
Okay.
So why is it that lenders can't admit that working capital is nothing more than predatory MCAs? Why can't they tell the truth?
Okay. So first of all, again, we're an outsourced accounting provider. We have really no dog in the fight. We help our clients get some sort of financing in whatever way best fits their needs. And so, first of all, the definition of an MCA is a merchant cash advance. So the basic structure is, hey, if I'm the business owner, I'm selling my future receivables or sales, and the let's call them lenders for now, are taking a percentage of sales in the future. Now, a lot of our clients ask us about these. They ask for, hey, how can we get the best financing for our needs? And just like there's stages of accounting, there's also stages of financing. And if you are just starting out as a business and you have some sales, but you've only been in business for a year, you're not going to be able to go to Wells Fargo or Bank of America and get an asset-backed loan or a working capital loan. The banks aren't going to. You don't have enough history developed with them to go get what would most likely be the cheapest financing in terms of cost, but you have to give up something in return for that. You have stricter reporting requirements. You have to meet specific covenants. You may have to move all your deposits to that bank. So companies like Settle that are, I'll call it, sorry, Anna, to speak for you, but an alternative lender, serve a very specific purpose for a very specific audience. And for companies like Settle, again, what do you get and what do you give? Yes, you end up paying a higher percentage on average than you would at Bank of America, Wells Fargo, or the SBA. However, they have more lenient terms than a bank does traditionally. You don't have to be in business for as long. You don't have to have audited financials. They may have more lenient covenants. So I want to just define this specifically, that in each of those stages, in each of the financing lenders of the world, you give something and you get something. So I just wanted to address that question directly and give a more long-winded answer, because I think it's really important, because we get this question a lot.
Super thoughtful answer. Anna, did you have anything that you wanted to add?
No, I think that's like, you took the words right out of my mouth. I think it's very much like, there's different scenarios that your business is going to go through as it scales, and those are going to be better suited to different types of financial partners who you're going to bring on. So yeah, really just like important to get an understanding of like what your business needs, what it can service, what is going to like help it get to the next stage. And that's going to absolutely vary over time.
Nice. We did get one more question that actually came through as we were having that discussion. How do you find most organizations manage the interface between order and inventory management and accounting? Specifically, cash flow with respect to common payment terms with vendors, i.e. 20% down, then 40% after first shipment, 40% second shipment, and the constant moving around of dates and timelines.
Yep, exactly. This just speaks to the complexity of the business, and as you grow, things get more complicated, and it takes those accounting systems and people to deal with it. So there's a lot to unpack here. Jeff, you can tell me how much time I have to answer this question, and I'll keep it
You have
even
as much time as you need. Go ahead. This is what we're here for.
Yeah. So in general, you want to first establish what your source of truth is for each of these items. So are you using let's call order inventory management? Is the source of truth some piece of software? Is it the accounting software? What is the source of truth? And on the accounting side, again, you're going to continue to put in those purchase orders. And then when you receive the invoice, matching that with the purchase order. And so you should have one place where you can see all of your open purchase orders, what you've put on deposit, what you still have to receive, and then the invoices that you have received and paid. And again, typically for us, that is QuickBooks or NetSuite. Then from cash flow, I think really you're asking two different questions. First question is what happened in the past, and if you're building to, or you have investor ready financials, the cash flow statement is where you want to be, and that will give you a great history of how cash has moved in your business. But then we have the future state of, okay, well, how much cash am I going to have to spend over the next 90 days, 3 months, 6 months, 12 months? It doesn't matter. And for that, we typically need to use a different tool, because QuickBooks isn't the best at that. So we're using a different tool, or just a simple Google Sheet, kind of whatever matches, again, the complexity of the business. And you have to map out all of those specific terms. We see that all the time. If it's 20% down, 40% after shipment, and then 40% after the second shipment, we've seen clients that have 5 different tranches of when those payables are due. And if you're multiplying that across, you have 3 different factories that each have their own payment terms. We have to make sure that we account for all that too. So it's a great question, and we deal with this problem a lot. And of course, they're all, moving dates and timelines. And again, it goes back to the principles of having the people to support that. If you have someone that's talking to your manufacturers or suppliers daily, weekly, whatever, and getting that updated timeline, you can plug that into we'll call it a cash flow model, to where you get the latest and greatest information about what that future cash flow looks like. Okay, Jeff.
You did it. That was amazing. And you know what? I will say that everyone stayed on. So I think you could have gone even longer on that one. So Sam and I just wanted to say a big thank you for joining us on today's webinar. Super informative, super thoughtful. I feel like I learned a lot myself, and I hope that the audience got as much value as I did. Thanks and have a great weekend, everyone.